When we think about discipline in trading, we usually think of only one of two things: sitting in front of the screen for 12 hours a day, or professional traders wearing glasses with faces as cold as stone, whose hands never shake when they click the buy or sell button. When people like you and me say we want to become more disciplined traders, it usually means a few things. I want to stop breaking my trading plan. I want to stop taking profits too early. I want to stop holding losing trades for too long, just because I refuse to admit I was wrong. And I want to stop opening ridiculous trades at 2 o'clock in the morning, because my brain keeps whispering that this is an opportunity I simply cannot miss. But there are two problems. The first problem is that discipline in trading is not easy. If it were easy, everyone would be a consistently profitable trader. No one would ever blow up an account. And the statistics showing that more than 80% of retail traders lose money over the long term would not exist. The second problem is that we think reading one article about trading psychology or watching one video about discipline will somehow make us disciplined the very next day. But we all know exactly what really happens. The moment a trade starts moving against us, everything we just read, everything we just watched, completely disappears from our minds. The amygdala grabs the steering wheel, and we end up doing exactly what we have always done. So how do you actually become disciplined in trading? But before we talk about how, we first need to understand why discipline in trading is so difficult in the first place. Why do we know exactly what we should do, yet still fail to do it? And why does that not mean we are weak or incapable? First, ask yourself one simple question. Why do you want to trade with discipline? Maybe it is because you already have a strategy, or at least a set of rules, that you believe can make money if it is executed correctly. But every time you sit down in front of the screen, something inside you keeps breaking those rules, and you do not understand why. That is because every technological advancement in modern society has trained our brains to crave instant rewards and avoid discomfort at all costs. And that makes disciplined trading far more difficult than most people tell you. For example, you have a trade that is currently up $800. Your strategy says the target is $2,000, but you keep staring at that $800 profit, and you feel an overwhelming urge to close the trade right now. Thoughts keep running through your mind. What if it reverses? $800 is still $800. Just take the profit. You want to feel like you are in control of the market. But in reality, the market is moving against your position, and you have no idea where it will stop. So you move your stop loss farther away, because the feeling that you are still managing the situation is more comfortable than admitting that you are losing. You just got stopped out, you are angry, and you want your money back immediately. So you open your next revenge trade within 5 minutes, with a larger position size, and with almost no meaningful analysis. So how do you actually become disciplined when everything seems to be working against you, including your own brain? Let's use the example of a gym membership, because I think it will make what I am about to say much easier to understand. Most people buy a gym membership at the beginning of the new year. During the first month, they go consistently. By the second month, they go less often. By the third month, the membership card just sits quietly in their wallet, serving only one purpose: making the wallet heavier. But every now and then you meet people who have gone to the gym consistently for years. Not because they enjoy sore muscles, not because they have more free time than you, but because they have reached the point where not going to the gym feels stranger than going. Discipline in trading works exactly the same way. No one is born with trading discipline. Even the most professional traders, the ones who can sit calmly while their account is in a $50,000 drawdown, were once people who broke their trading plans, opened revenge trades, and moved their stop losses. The difference is that they have experienced enough pain to understand something that most traders never truly accept at the deepest level, and that thing is not a new strategy. It is not a better indicator. It is not another psychology book. It is an understanding of how their brain actually works inside the trading environment. And from that understanding, they build a system that works with the brain instead of fighting against it. Now let me put on my overthinking glasses and talk about a little science, but I promise I will not put you to sleep. Inside your brain, there are two regions that you need to know about. The first is the amygdala. It is the emotional center, the fast reaction system. It was designed to protect you from immediate danger. When the market moves against your trade and your account is bleeding, the amygdala activates the same way it did when your ancestors came face to face with a tiger. Your heart beats faster, your thinking becomes narrower, and the only thing your brain wants is to do something right now to stop the pain. The second region is the prefrontal cortex. This is the part responsible for logic, planning, and impulse control. It is the part that knows you should respect your stop loss. The part that understands a losing trade is simply part of the normal range of your strategy. the part that can see the bigger picture instead of getting pulled into every small price movement. The problem is that when the amygdala becomes highly activated, it suppresses the activity of the prefrontal cortex. In other words, at the exact moments that matter most in trading, when the stakes are highest, when emotions are strongest, when your decisions carry the greatest consequences, your brain is in the worst possible state for making rational decisions. This is not your personal weakness, it is human biology. But this is also good news, because once you understand that, you stop trying to solve the problem the wrong way, and you begin solving it the right way. The wrong way is trying to force yourself to be disciplined through willpower while your emotions are running wild. That is like trying to solve math problems in your head while someone is screaming directly into your ear. You can try, but the result will not be good. The right way is making your important decisions before your emotions become activated. Then building barriers that force those decisions to be carried out, even when your amygdala is begging you to do the opposite. This is the core difference between disciplined traders and everyone else. They are not more disciplined than you while they are trading. They are more disciplined than you before they ever sit down in front of the screen. So, what does that actually look like? Let's begin with the first and most important point. Understand that discipline in trading is not a personality trait. It is a skill. And like every other skill, it is built through deliberate practice, not by reading more books, not by watching more videos. Trading discipline is like a muscle. You have to train it, and you have to train it the right way. Not by trying to lift the heaviest weight on your very first day, but by starting with a weight you can actually handle, then gradually increasing it over time. Now, take a look at your own trading habits. When was the last time you broke your plan? Was it after losing 2 trades in a row, when you immediately opened a third trade to get your money back? Was it because you saw another currency pair moving aggressively and jumped in, even though it was never part of your strategy? Or was it because your trade was in profit and you closed it early before reaching your target simply because you were afraid it might reverse? If the answer is yes, then that is a clear sign that you are not yet ready to build discipline at a higher level, because you still cannot control your most basic automatic reactions while trading. You need to begin with small acts of discipline. The way you follow small rules is exactly the way you will follow big rules. If you are not disciplined enough to respect your stop loss on a $200 trade, how can you expect yourself to respect it on a $2,000 trade? When the emotional pressure is 10 times greater, that is like trying to run a marathon while you are still out of breath after climbing a single flight of stairs. The small rules, the habits that seem boring, writing in your trading journal after every trade, pausing for 3 seconds before clicking the button, setting your stop loss before placing the trade. All of these things are incredibly important, and they should never be underestimated. Because they happen many times throughout a single day, they give you far more opportunities to practice the correct response. Every time you respect your stop loss, even when you do not want to, you complete 1 repetition. Every time you refuse to open a trade because it does not meet the conditions of your strategy, even though your emotions keep telling you to enter, you complete 1 repetition. Every time you hold a winning trade all the way to your planned target, instead of taking profits early, you complete 1 repetition. Little by little, your brain begins building new neural pathways. Disciplined responses gradually become more automatic than undisciplined ones, not because you became a different person, but because you retrained your brain through repeated actions. This is very similar to compound interest. Every time you act with the discipline, the impact does not seem very significant on that particular day, but after 3 months, 6 months, 1 year, those small actions compound into something that cannot be built any other way. Now, if you do not know where to begin, try this one specific exercise. Create a set of non-negotiable principles for your trading, not profit targets, not the number of trades you should take each day, but behavioral rules that you commit to following, no matter what happens. For example, I never move my stop loss farther away after it has been placed. I never open another trade within 30 minutes after being stopped out. I never double my position size just because I have been on a winning streak. Those are non-negotiable principles. Not vague goals like, I will try to be more disciplined, but hard boundaries that you simply do not cross, no matter what your emotions are telling you. I do not enjoy sitting there watching a trade move against me without doing anything. That feeling is deeply uncomfortable. But by creating these non-negotiable principles, I force myself to face that discomfort instead of escaping from it by moving my stop loss. And every time I successfully sit through that discomfort, I am training the exact muscle that trading demands. However, you should begin with principles that are simple and realistic. Do not create 10 rules on your first day. Choose 2 or 3 rules that you know you can realistically follow almost every day. Start there. When they become natural, add more. Some people believe that discipline in trading means forcing yourself to endure discomfort all day long, from one trade to the next. From the outside, that certainly seems true. But there is another way to look at discipline. And this is the perspective shared by the most consistently profitable traders I have ever known. Discipline in trading is an act of love for your future self. If you genuinely care about your financial results 1 year from now, or 10 years from now, you will not take profits early just to feel better right now. You also will not hold losing trades for far too long, simply because you do not want to officially admit that you were wrong. You will not open a revenge trade with double the position size at 2 o'clock in the morning, only to watch your account go from a $500 drawdown to a $2,000 drawdown within a single hour. If you truly care about your future self, instead, you will do the things that version of you will one day thank you for. You will never regret cutting a loss exactly according to your plan, but you will always regret failing to do it. Think about it seriously. Have you ever looked back at a trade and said to yourself, I wish I had ignored my stop loss. I wish I had not followed my trading plan. I wish I had opened another trade even though there was no valid setup. Never. Now really think about your future self. Letting losses keep running because you refuse to cut them will hurt 24 hours a day until your account finally reaches zero. Cutting the loss according to your plan only hurts for about 3 seconds, the moment you click the button. Continuing to break your plan because of emotions means you will never know whether your strategy actually works, because you never execute it consistently enough to find out. Following your plan long enough to gather real data gives you the most valuable thing in trading, the truth. Allowing unrealistic expectations to control your behavior will make you overtrade, risk too much, and rush into decisions. Adjusting your expectations to a level that is actually realistic sets you free from the pressure you created for yourself. Whenever I face a difficult trading decision, such as watching a trade move against me without moving my stop loss, or rejecting an attractive setup because it does not meet my rules, I always ask myself one question. What would the version of me 1 year from now want me to do right now? That question is not always easy to answer, but it always gives a better answer than the amygdala. Now imagine that your trading morning is like eating breakfast. You wake up and immediately pick up your phone. You check the charts, you read market news, you see what everyone is saying about the currency pair you are watching. You jump into a trading group and discover that 3 people are convinced the market will rally today. 2 people say it will crash, and someone else is proudly showing off the $3,000 they made before 6 o'clock this morning. Now you sit down in front of the screen. Your brain has already been flooded with noise, conflicting opinions, and comparisons with other people. Your amygdala is already highly activated before you have even opened a single chart. Then you see a setup and enter a trade. Not because the setup actually meets your criteria, but because your brain is now in a state where it feels like it has to do something. This situation is very similar to starting your workday by reading customer complaints, then sitting through a meeting with an irritable boss before finally trying to do your real work. By the time you sit down to focus, your brain has already burned through most of its cognitive resources before the real work has even begun. That is why your mental condition before sitting down in front of the screen is just as important as your trading plan. If every morning begins with social media before you trade, you are filling your own mind with noise before the market has even created a single opportunity. The best traders usually do something very different. They create a period of calm before sitting down at the screen. Their minds are clear, focused, unaffected by outside noise. It does not have to be meditation or yoga. It might simply be drinking coffee in silence, taking a 15-minute walk, or reading through your trading plan for the day. Anything that helps you sit down while your prefrontal cortex is fully engaged, instead of allowing your amygdala to take control first. That is also why one of the most important rules disciplined traders follow is knowing when not to trade. Not because of market conditions, but because of their own condition. Have you just been stopped out twice in a row and you are frustrated? That is not the right day to continue trading. Are you dealing with something stressful in your personal life? That is not the right day. Did you sleep poorly? Are you exhausted? Unable to focus? That is not the right day. If you are unsure what state you are in today, ask yourself one simple question before you sit down in front of the screen. Am I in the right mental state to make trading decisions today? Are you still carrying frustration from yesterday? Are you dealing with stress from your life outside the market? Are you sleep-deprived, tired, or distracted by something else? If the answer to any of those questions is yes, then today may not be the right day to trade. Or at the very least, it should be a day when you significantly reduce your position size, and only trade the clearest, highest quality setups. That may sound like a sacrifice, but think about it. If during 1 month there are 5 days when you are not in the right state, and you choose not to trade on those days, yes, you will miss some opportunities, but you will also avoid some of the worst decisions you could possibly make. And in trading, avoiding major mistakes is just as important as finding great opportunities. If, for some reason, you still find all of this difficult to apply, I want you to try one specific exercise. Take a blank sheet of paper. Write down every trading behavior that the disciplined version of yourself would demonstrate. Not the results, the behaviors. How would that trader place a stop loss? How would that trader respond after being stopped out? Would that trader ever open a revenge trade? What would that trader do when a winning position is approaching its target? Write every one of those behaviors down in as much detail as possible. Then every single day, try to become that trader. It may sound a little strange, but it works for a very practical reason. The human brain acts consistently with the identity it believes it has. If you identify yourself as someone who always breaks the trading plan, your brain will constantly search for evidence to confirm that identity. If you begin identifying yourself as a disciplined trader who is still in the process of improving, your brain will begin looking for ways to confirm that new identity. This is not self-hypnosis. It is not naive positive thinking. This is simply how identity actually works in human behavior. Make discipline part of your identity, not something you are trying to obtain from the outside, but something you are building from within. People often believe there must be some secret, a special indicator, a better strategy, a single book that will automatically turn them into disciplined traders. You can try all of those things. In fact, you probably should. But in the end, everything still comes down to one thing: doing what needs to be done in trading, even when your emotions are telling you not to do it. Cut the loss when your plan says to cut it, even though it hurts. Hold your winning trade until it reaches its planned target, even though you desperately want to take profits early. Do not enter a trade when there is no valid setup, even though you are terrified of missing out. That will feel uncomfortable, especially during the early stages when your old habits are still stronger than your new ones. But eventually that discomfort will reward you, not only with money, but with something far more valuable to anyone who is serious about this profession. Trust in yourself. The certainty that regardless of where the market goes, whether this trade wins or loses, you made the correct decision according to your plan. And that, not the outcome of any single trade, is the true foundation of consistency in trading. However, I want to go deeper into some of the specific mechanisms working quietly beneath the surface, the psychological traps that operate without you noticing, silently destroying your discipline every single day. But before we talk about those traps, I want to discuss a tool that almost everyone has tried, yet almost everyone has given up on. And the reason it fails is actually more important than the failure itself: the trading journal. Almost everyone has heard this advice. Almost everyone has tried it, and almost everyone has abandoned it after only a few weeks. The reason is not that a trading journal does not work. The reason is that most people use it the wrong way. They record the numbers, where they entered, where they exited, how much they made, how much they lost. After 1 month, they look back at the summary and all they see are numbers. But those numbers tell them nothing about why they made the decisions they made. And because of that, they cannot change anything. A real trading journal, the kind that can actually help you build discipline, records your psychological state at every important moment. Before entering a trade, how are you feeling? Are you excited because you have just had a winning streak? Are you frustrated because you have just taken a loss? Are you entering this trade because there is a genuine, high-quality setup, or simply because you cannot stand watching the market move without being involved? While holding the trade, what is happening inside your mind? Are you checking the chart every few minutes? Are you beginning to search for reasons to exit early before your original plan? After closing the trade, how do you feel? If the trade was a winner, but you feel more lucky than confident, that is an important signal. If the trade was a loser, and you feel angry at the market instead of curious about what you could learn, that is also an important signal. After recording enough trades this way, usually somewhere between 50 and 100 trades, you will begin to notice patterns in your own behavior that were impossible to see from inside each individual trade. You may discover that your best trades happen when you are neither excited nor anxious, when you are simply following your process, and your worst trades often happen at the moments when you feel the most certain about the outcome. The most valuable data in trading is the data about yourself, collected from yourself. And it only comes through patient, honest observation over time. There is another important lesson. You must learn how to measure yourself the right way. Most traders measure success by results, how much money they made this month, whether this trade was a winner or a loser. That sounds completely reasonable. But here is the problem with measuring success that way, especially when you are trying to build discipline. In trading, you can make a perfectly correct decision and still lose money, because markets contain randomness that can never be eliminated, and you can make a completely wrong decision and still make money, simply because luck happened to be on your side. If you measure success only by results, you are accidentally rewarding undisciplined behavior whenever it happens to make money. Your brain learns, breaking the plan equals making money, and it strengthens that behavior, even though the outcome was nothing more than random chance. This is one of the most dangerous ways to learn trading, and it happens automatically, beneath your conscious awareness. A truly disciplined trader measures success by the quality of the decision-making process, not by short-term results. The question they ask themselves is not, how much money did I make today? It is, did I follow my trading plan? Did I respect my risk management rules? Did I enter because there was a valid setup or because of my emotions? If the answer to all of those questions is yes, then it was a good trading day, regardless of whether the final result was profit or loss. That single change in how you measure yourself completely transforms the way you experience trading. And over time, as you continue measuring yourself by the quality of your process, your long-term results naturally improve, not because of magic, but because you keep making better decisions based on analysis instead of emotion. The first trap is confirmation bias. The human brain does not like uncertainty. And to reduce that discomfort, it does something very interesting. It searches for information that confirms what it already believes, while ignoring or minimizing information that contradicts it. In trading, it looks like this. You analyze a currency pair and conclude that it is going to move higher. The moment that conclusion takes hold, your brain automatically begins filtering information. It gives more weight to signals that support your bullish view, while downplaying or rationalizing the warning signs. A bearish reversal candle appears. You tell yourself it is just noise. A major support level has just been broken. You convince yourself it is only a liquidity sweep before the market continues higher. Negative economic news is released. You assume the market has already priced it in. Every one of those stories sounds reasonable in the moment, and that is exactly why they are dangerous. Your brain is not consciously lying to you. It is simply doing what it was designed to do. Protect the conclusion it has already invested in. Disciplined traders deal with this trap through one very specific habit. Before entering any trade, they force themselves to answer the opposite question. Not, why should this trade win, but why could this trade lose? What condition on the chart would prove that my analysis is wrong? If I were on the other side of this trade, what would I be seeing? That question is uncomfortable. It goes directly against what your brain wants to do. And that is exactly why it works, because it forces you to see the entire picture instead of only the part you want to see. The second trap is the sunk cost fallacy. But before we talk about that, I want to pause on something that most people completely overlook when discussing discipline. You also need to know when your strategy has genuinely stopped working and how to distinguish that from nothing more than a normal drawdown. This is one of the most subtle challenges in trading. A drawdown, the period when your account declines from its previous peak, is unavoidable in every strategy. There is no strategy in the world that never experiences a drawdown. Even the largest hedge funds in the world go through extended periods of losses. When you are in a drawdown, your brain does all the wrong things. It wants you to trade more to win the money back. It begins questioning your strategy. It whispers, this strategy does not work anymore. The market has changed. You need a different approach. And this is exactly where so many traders go broke. Not because their strategy actually stopped working, but because they abandoned it right before market conditions became favorable again. To avoid falling into that trap, you need to know your strategy statistically. What has been its largest historical drawdown? What is the longest losing streak it has ever had? If you do not know those numbers, you will never be able to remain calm through a normal drawdown, because you have no reference point to tell you whether what is happening is normal or abnormal. And when you have no reference, your brain fills the gap with fear. The classic sentence of this trap sounds like this: I have already lost $3,000 on this trade. I cannot close it now. I just need to wait until it gets back to break even. That sounds perfectly reasonable, but the truth is that $3,000 already belongs to the past, whether you close the trade or not. The only question that actually matters at that moment is this: if I did not already have this position, and I were looking at the market right now, would I willingly open this exact trade in this direction? If the answer is no, if you would not choose to open the same trade right now, then you are holding it because of sunk cost, not because of analysis. And that is a clear signal that the trade should be closed. Disciplined traders learn to treat every moment in a trade as a fresh beginning. Whether that $3,000 has already been lost or not does not change the current analysis. The only thing that changes the analysis is what the chart is telling you right now. The third trap is tying your identity to your trading results. Many traders define themselves by what happens inside their trading account. After a winning streak, they feel smart, talented, gifted. After losses, they feel incompetent. Maybe they were never meant for this profession. When your identity is attached to your results, every losing trade becomes more than a financial loss. It becomes an attack on your ego. And when your ego is under attack, your brain starts making decisions to protect your identity instead of protecting your capital. That is when you keep holding a losing trade, because closing it means admitting that you were wrong. That is when you increase your position size after a losing streak, because you feel the need to prove to yourself that you are still a capable trader. Disciplined traders define themselves by their behavior. I am someone who follows the trading plan. I am someone who keeps learning. I am someone who manages risk properly. Those identities do not depend on whether their account went up or down this month, and when they lose, their response is not, I am a failure. Their response is, this trade lost. Did I execute my plan correctly? What lesson can I learn from this? That difference in wording may seem very small, but the difference in behavior is enormous. One person is protecting their ego, the other is learning and growing. Those are two journeys that eventually lead to completely different destinations after enough years in the market. This is also closely connected to the way you learn from your trading experience. Most people learn the wrong way. When they lose, their brain immediately wants an explanation. Because the losing trade is fresh and emotionally vivid, their brain usually blames the most obvious thing. For example, you lose a trade during an important economic news release. Your brain concludes, I lost because of the news. Then you create a new rule. Never trade around news events, but that story may not be true. Maybe you did not lose because of the news. Maybe your technical entry was poor, or perhaps your trade management was weak. The news was simply the easiest thing to notice. That is why analyzing aggregated data is far more valuable than trying to learn from one individual trade. Look at every trade taken under similar conditions over time. Ask yourself, across 30 trades taken around news events, what was my overall win rate and performance? That is the question that matters, not why did I lose that one trade. Disciplined traders do not learn from one trade. They learn from hundreds of trades, and they rely on statistical data, not emotional memories, to draw meaningful conclusions. That is why a trading journal is not something you write just to stay organized. It is a tool for collecting data about yourself. Data that, given enough time, will reveal things you could never see from inside a single trade. The fourth trap is recency bias. The human brain naturally gives too much weight to what has happened most recently, while undervaluing what happened further in the past. In trading, this creates very specific consequences. Have you just had 5 winning trades in a row? Recency bias makes you believe your strategy is on fire, that the market is perfectly aligned with your approach, that the next setup is also likely to win. So you increase your position size, even though the probabilities have not changed at all. Have you just had 4 losing trades in a row? Recency bias makes you believe your strategy has stopped working, that the market is against you, so you reduce your position size. Or you stop taking valid setups altogether, right before the market may be about to turn back in your favor. In both situations, you are reacting to short-term feelings instead of long-term data. Disciplined traders fight recency bias by returning, again and again, to one simple question. Is my current streak still within the normal range of this strategy? If your backtesting shows that the longest losing streak is 6 trades, and you are only on your 4th loss, then nothing unusual is happening. The data, not your feelings, should determine whether you continue or stop. The 5th trap is revenge trading. This happens far more often than most people realize. Almost everyone has experienced it at least once. But very few people call it by its real name. When you lose a large trade or go through a losing streak, your brain enters a very unusual state. It is not simply anger, although anger may certainly be part of it. It is a combination of wounded pride and an overwhelming need to fix the situation immediately. In that state, you are no longer thinking about your strategy or your trading plan. You are thinking about getting back what you just lost. Most people already know what usually happens next. The following trade is often worse than the previous one. The position size is larger, the analysis is weaker, and the increased psychological pressure causes you to take profits too early when you are winning, or hold far too long when you are losing. The most effective way to deal with revenge trading is not willpower. It is a hard rule created beforehand. For example, after losing more than a predetermined amount on a single trade, turn off your trading platform and do not trade again until the following day. No exceptions. That rule is not based on how you feel in the moment, because that is precisely when your judgment is the least reliable. This is also a perfect example of designing a system instead of relying on willpower. Willpower is limited. It becomes exhausted very quickly during emotionally intense situations. A rule created beforehand does not require willpower in that moment. It simply needs to be followed, and that brings us to the very center of everything we have discussed. Your relationship with uncertainty. At its core, trading is the profession of managing uncertainty. Nobody knows where the market is going next. Anyone who tells you otherwise is either lying to you or lying to themselves. The human brain does not enjoy uncertainty. It constantly searches for patterns, rules, and signals that might allow it to predict the future and control the outcome. And this is the source of so many undisciplined behaviors in trading. People keep adding more indicators to their charts because every additional indicator creates the feeling of greater control, even though that feeling is an illusion. People wait for the perfect setup without realizing that a perfect setup does not exist. And waiting for certainty inside a probabilistic environment is the perfect formula for never becoming a consistent trader. People refuse to cut losses because cutting a loss means admitting they were wrong. And the brain avoids that discomfort by creating convincing stories about why the market will eventually reverse. Every one of those behaviors comes from the same place, an inability to accept the uncertainty that exists inside every single trade. Real discipline in trading begins the moment you truly, not just intellectually, but emotionally, accept that every trade can move in either direction, regardless of what your analysis suggests. Once you accept that, something very interesting happens. You stop needing this trade to win. And when you no longer need it to win, it becomes much easier to respect your stop loss, because you already accepted the possibility of losing before you entered the trade. You also become much more capable of holding winning trades all the way to their targets, because you are no longer clinging to every dollar of unrealized profit, afraid it might disappear. Accepting uncertainty does not make you a worse trader. It makes you a better one, because it frees you from the pressure you create by trying to control what can never be controlled. The sixth trap is unrealistic expectations, one of the quietest yet most powerful reasons so many people never develop real discipline. Most people enter trading expecting to make huge profits very quickly. They see screenshots of accounts doubling within a month, and they enter the market with an image of success that has very little to do with the reality of most professional traders. The truth is that the most consistent traders, the ones who make money year after year, rarely have those spectacular months. Instead, they produce returns of around 3% to 8% on their capital, consistently, month after month, year after year. When those returns compound over time, they create real wealth. But in the short term, they never look dramatic or glamorous. The problem is this. When your expectation is making 50% every month, you will never feel satisfied with 5%. And when you are not satisfied with 5%, you will constantly increase your risk, search for bigger setups, and take far too many trades because those smaller gains never seem worth the time and effort you invested. That pressure is what destroys your discipline, not a lack of knowledge, not a lack of strategy. Disciplined traders adjust their expectations to match reality. Each trade is simply one trade, one small piece of a much longer series. No single trade needs to be the trade that changes your life, and because of that, they are able to execute each trade with a level of calm that people who place enormous expectations on every position can never experience. Now, I want to talk about something subtle, yet incredibly important. The difference between a disciplined trader who loses less often and a disciplined trader who loses the right way. This is the most important mental shift every trader must eventually make, and yet it is also one of the least discussed ideas. If you believe discipline means losing less, you will spend all your time trying to avoid losses. You will move your stop loss farther away. You will add to losing positions. You will refuse to close a losing trade, simply because you do not want to make that loss official. Every losing trade will feel like proof that your discipline has failed. But once you understand that discipline means losing according to your plan, everything changes. Every stop loss executed exactly as planned becomes an act of discipline, not a failure of discipline. You no longer need to avoid losses. You simply need to lose the right way. And when you lose the right way according to your plan, according to your risk management, with an appropriate position size, those losses will never be large enough to destroy your account. And when the winning trades arrive, they will be large enough to recover those losses and produce an overall profit. From here, I want to discuss one final idea before we finish. The difference between discipline and rigidity. Some traders hear about the importance of discipline and interpret it to mean they must follow every rule absolutely. Never adapt, never adjust, never change. Then, when they realize their strategy no longer fits the current market conditions, they become unsure whether they are even allowed to modify it. Because every adjustment feels like breaking discipline. But here is the important distinction. Discipline means executing your current plan correctly while you are actually trading. Reviewing and improving your strategy based on data is an entirely different process, one that happens outside trading hours while you are calm, clear-headed, and emotionally stable. Discipline does not mean never learning. It does not mean never changing. Discipline means those changes come from careful analysis and rational thinking, not from emotions in the middle of a trade. If you have executed a strategy across 200 trades and your data shows it has no positive expectancy, that is a perfectly reasonable reason to change it. If you want to abandon your strategy after only 3 consecutive losses, simply because it no longer feels good, that is not analysis. That is emotion pretending to be analysis. Disciplined traders review and refine their strategies regularly, perhaps once a week or once a month, based on aggregated data. But while they are actually trading, they execute their existing plan without changing it mid-trade because of temporary emotions. That is real discipline, not rigidity, not blind obedience, but consistency supported by a system. Emotions in trading are not the enemy that must be defeated. They are information about your internal state, about how much risk you are carrying, about the emotional baggage you have not yet processed from previous trades. The problem is not that emotions exist. The problem begins when emotions start controlling your actions instead of simply providing information. When a trade is losing and you begin to feel anxious, that anxiety is valid information. It is telling you that something inside you deserves attention. The real question is this: what do you do with that information? An undisciplined trader allows anxiety to flow directly into action, moving the stop loss, closing the trade too early, adding to a losing position. A disciplined trader treats anxiety as a signal to review the trading plan, not as a command to act immediately. The difference is not whether emotions exist. The difference lies in the space between the emotion and the action, and what you choose to do inside that space. Discipline in trading is not something you either have or do not have. It is something you build, day by day, trade by trade, small decision by small decision, the kind that nobody sees except you. Every time you respect your stop loss, even though you do not want to, you are building it. Every time you refuse to enter a trade because it does not fit your strategy, even though every emotion inside you is urging you to take it, you are building it. Every time you hold a winning trade all the way to its target, instead of taking profits early out of fear, you are building it. And every time you fail to build it, you learn something about yourself, if you are willing to look directly at the truth instead of blaming the market. The journey of building discipline, with all its difficulties, its failures, its lessons, and its slow but genuine progress, is the journey of becoming the trader you want to become. And that journey is not linear. There will be periods when you feel you have made real progress, weeks when you follow your trading plan almost perfectly, trades where you cut losses without hesitation, days when the market is extremely volatile, yet you remain calm. Then the market will present you with an entirely new situation, a level of volatility you have never experienced before, a drawdown that lasts longer than normal, or a period in your personal life filled with stress, and suddenly, you realize there are still psychological weaknesses inside you that have not yet been resolved. That does not mean you have gone backward. It means you are now learning at a deeper level. The most disciplined traders are not the people who have completely solved their psychological challenges. They are the people who have accepted that the struggle is a permanent part of this profession, and they have built a healthy relationship with it instead of trying to make it disappear. Every morning when you sit down in front of the screen is a new beginning. Every trade is another practice session. Every moment when your discipline is tested and you succeed, you are building something truly solid inside yourself. Something that no amount of profit or loss on that day can ever take away. You will not become disciplined just because you watched this video. But if you begin applying just one of the ideas I shared today and continue long enough for it to become a habit, then you have already taken one real step forward. Then another, then another. There are no shortcuts. But every step is worth it. And every time you choose to do the right thing in trading, even when no one is watching, even when the market does not reward you immediately, you are becoming the trader you want to become. One step at a time, one day at a time. Your future self will thank you for it, not only because of the numbers in your trading account, but because of what you have built inside yourself. A deeper understanding of who you are, trust in your own process, and the ability to stand firm in front of the market without being carried away by every emotional swing. If you found this video helpful, please subscribe to the channel so you do not miss the upcoming videos. We still have many more things to explore about trading psychology.